Hi there, my name is Srin Sridharan. I'm a partner and the head of investment research at Waypoint Investment Partners. Over the last few months, many of our clients and prospective investors have asked us to maybe outline in detail our investment process and philosophy and how we due diligence companies in the all-weather strategy. So today I'm lucky to sit down with our partner and portfolio manager, Marr, and the two of us are going to outline our investment philosophy, investment process, and how we take securities and make sure they're the right weights in the portfolio. So Ryan, as you know, a lot of our clients ask us quite a bit about our investment process. That's how we diligence companies and how we find them and how they fit within our portfolio. So today I thought we could discuss three things. Our investment philosophy, which is where we hunt for companies. Our investment process, which is how we due diligence those companies. And then talk a little bit about our portfolio management approach, so how those companies fit within the portfolio.
Yeah. Sure.
Cool. So maybe I'll start by asking you, when it comes to our investment philosophy, you always had a very refined view about how to hunt within the Canadian market for specific companies. So maybe you could talk a little bit about that.
So at Waypoint, we like to focus on a fairly narrow set of securities, Canadian listed securities, largely based on our expertise in the non-resource segment of the Canadian market. And in Canada, for reference, there's approximately 3,500 publicly listed companies. And when you remove the large cap financials, energy, and material sectors, you're left with approximately 425 companies. And if you had owned that subset of the Canadian equity market over time, you've actually performed very well. It's been a great place to look for investments. Where we like to refine that further is by focusing on those companies that we believe are really on the edges of what we consider the investment spectrum. And these are those companies that have a very defined cash flow distribution policy, whether through dividends and buybacks, on one edge of the spectrum. And those companies that look to capital markets as ways of raising equity or debt to accelerate growth, we consider those capital compounders. And those two criteria, those two sectors, segments of the Canadian market, bring you down to about 110 companies from that 425. And that's where we like to focus in the portfolio. And then within the portfolio, we select approximately 20 to 25 within that universe.
So Ryan, you mentioned two types of companies, capital distributors and capital compounders. Maybe you could dive into first those distributors. What do those companies look like?
So the capital distributors are those companies primarily that are paying large dividends to their investors. And within that, the criteria we look for are companies where the management teams or founders have meaningful stakes in their business. That they manage the business quite conservatively with respect to the capital structure, so they don't have a lot of debt, and that they have a very explicit policy for distributing their cash flows to investors. On the capital compounding side, these are those businesses that are really the growth companies in Canada. And there we're looking for businesses that have a track record for raising, whether it's equity or debt in the capital markets, to accelerate growth. We use that as our barometer for whether or not these companies are really earning returns above their cost of capital. Unfortunately, there's not that many great growth companies in the Canadian equity markets, but when you do find them, you can own them for long periods of time, especially when their addressable market is quite large. At any point in time, that segment of the portfolio, those capital compounders, are about 10 to 30% of the portfolio, and we adjust those weights based on our general view of where we are in the economic cycle.
So on both ends of the spectrum, you have these distributors and you have the compounders, and there's this big gap in between. So why do you avoid the companies that are sort of in between or don't fit one of these profiles?
Sure. So in our experience, we found that those companies that really exist in between are really fighting for investor mindshare of actually which bucket they should be in. And naturally, the growthier companies tend to trade at valuations that are much richer than some of these more stable businesses that might have more predictable revenue and earnings over a cycle. And as a result of that, companies in the middle tend to be working through investors debating over relative valuation and really where they should land on that spectrum. So we find that over time, by avoiding that, it reduces considerably the element of volatility in the portfolio.
Got it. So if I almost summarize back to you, it's kind of like the distributors on one end of the spectrum. They really focus on paying a dividend. They have strong cash flow profiles, and management's aligned and incentivized to pay that dividend.
That's right.
On the distributor side of things, these are companies that earn above their cost of capital, which is evidenced by their continuing access of the capital markets through debt or equity. And they also have strong management alignment and conservative balance sheets. And then in between, there's a bunch of companies that are logically going to be a lot of debate and you can't have a clear understanding of where their cash flows are coming from or going.
Yeah.
So it's almost that's the space to
That's right. In the Canadian market, especially when you're investing, you want to have a strong understanding of where you expect returns to come from within your portfolio. And by defining where you sit on this spectrum of investments, it makes it easier to manage and balance a portfolio for investors. So Srin, given that we're fundamental analysts as a foundational principle, can you discuss a little bit about the due diligence process that we go through with our team before a company or an investment makes its way into the portfolio?
Sure. Well, you and I were trained in a very similar way, and all of our analysis here at Waypoint starts with a rigorous fundamental analysis of the company. And fundamental analysis in our investment process has a few steps. So a fundamental investment process has a lot of very specific steps. It usually starts with a rigorous industry assessment and also taking a look at the company's business strategy, their moat, and their competitive advantages. We'll then do a very rigorous financial statement analysis as well as assess the management team very holistically. We take all that and start building a forecast, which eventually translates into a valuation model. And all that work done by our analysts then culminates into an investment thesis. So what goes into each one of those pieces? On the industry end, we tend to do a very detailed value chain analysis and assessment of the competitive landscape. We're trying to assess if the industry is actually attractive and one that we want to be understand and know how it behaves over the course of the economic cycle. In terms of business mode and competitive advantage, we focus on does the company actually have any competitive advantage and can we see that in their financial statements? Are there real barriers to entry in the industry and can we see that resulting in excess returns on invested capital? In terms of financial statement analysis, our analysts will dig into historical statements over time, disaggregate historical cash flows, and see the capital allocation decisions that management made historically. Then we actually want to assess management. We'll have several meetings with them over the course of many, many months, really dig into how they think about capital allocation, how they make cash flow decisions, and also see if there's alignment and ownership alignment specifically. Do they own a lot of the company's stock, and are they incentivized to behave the right way, or the way that we as shareholders want them to behave? Taking all of that work, we're then able to build an assessment and a forecast. And that forecast usually focuses on growth, margins, and the translation of those margins into free cash flow. All of that then builds into a valuation model. And we use very traditional fundamental valuation methodologies, namely a discounted cash flow method, or any other alternative valuations that may make sense for that specific company. And if you take all that, it basically culminates into an investment thesis, which is our view of how we make money on the stock. The total shareholder return model is a framework that we use to take all the work that's been done by our analysts, disaggregate that work, and know explicitly where we expect returns to come from our investment. So the TSR model works as such. It basically takes returns and breaks them into two buckets. One, capital gains that we sort of expect to make, or the change in share price that we expect to see from our investment. And two, the usage of non-reinvested cash flows. So let me explain what that means. Companies obviously generate cash flow and they take some of that and reinvest it into their business. But they can also use some of that cash flow and pay it back to shareholders. And they can do that in one of three different ways. They could pay a dividend, they could do a share buyback program, or they could repay debt. In particular, Ryan mentioned how we seek capital distributors as a big part of our portfolio. And so we specifically hunt for companies that either pay a dividend yield or have a share buyback program. Those are explicit sources of return that we can quantify, and we know that those returns are going to come back to us. Then moving up to the top of the TSR framework, we focus on capital gains. As fundamental analysts, we're really focused on trying to develop a view of intrinsic value. And we take that view and break it down into two further buckets. One, the change in fundamental value that we expect, and two, the change in investor expectations that we're expecting. In terms of change to fundamental value, we can look back at our analyst forecast and say, how much of the new value this company generates is going to come from growth, from margin growth, and from free cash flow growth. And in terms of change in investor expectations, we really want to understand where market expectations are relative to ours. And that's an important thing to just know, so that we're very aware of where those returns need to come from. By disaggregating returns in this way, we're able to clearly identify if companies fit the capital distributor profile or the capital compounder profile, and where we expect our returns to come from.
So Srin, that sounds like quite a rigorous assessment. Do we do that for all of our investee companies?
That's a great question. So no, we don't do that whole scope of work for all the companies. What we have is a 1 week, 1 month, and then a long-term process for getting all this work done. So, at the start of the video, you outlined very specific criteria for what makes a capital distributor and what makes a capital compounder. So we can use those criteria over the first week to even filter companies to say, is this something we're actually interested in and fits one of those profiles. Then we might spend a month really starting down some of the analyses I mentioned, looking at the value chain, looking at the industry, starting to build a model, and usually we'll have a very important first meeting with management. We're able to test a lot of our thesis and ask some very important questions about alignment and capital allocation. If at that point we were starting to really increase our conviction and think that this could become a large weight in the portfolio, then we double down and do all this rigorous work before making it a large weight in the portfolio.
So given the amount of work that gets completed, can you discuss some of the outputs, the actual tangible work that is produced from the analysts?
Sure, that's a great question. So as we finish all this work, what you usually find is one, we'll have a very detailed investment thesis memo. This outlines the thesis that we've all sort of agreed to, why it fits the profile of a compounder or distributor, and as well as the detailed TSR model that disaggregates returns. Behind that memo is a very, very rigorous valuation model. It includes, a discounted cash flow method as well as any other alternative valuations that made sense. It also tends to include, all the forecasting, growth, margin assumptions that we made over time. And then, thirdly, we have a very detailed documentation process for all of our management meetings, company notes, quarterly calls, and updates along the way.
Great.
So Ryan, after all that work is done on individual companies, how does that translate back into specific weighting within the portfolio?
Yeah, so our highest conviction ideas are always our largest weights within the portfolio. And as you mentioned, it's an ongoing research process when we hold such large positions because we're constantly trying to maintain our conviction on these names, as well as be mindful of how the stocks have performed, making sure that we're reducing weights when they're trading well above our estimates of intrinsic value and increasing weights when they're trading below our estimates of intrinsic value. Within that 110 equity universe that we focus on, we think we're searching with the right selection of securities. So we look for 20 to 25 that are best suited for the portfolio.
Mm-hmm. Well, it sounds like a few really, really strong principles, right? Hunt in a universe where you think it's superior to maybe other groupings or universes in the Canadian market. Focus on your highest weights and make your highest conviction names are your highest weights. And then for smaller weights, increase your conviction over time and wait for more evidence before they become higher weights.
That's right. Thanks very much for watching. We hope we answered some of the questions that we have been receiving from investors and prospective investors. For more information, you can contact us at the information on the screen. Thanks very much.